Hello, good day, sir. Good day to you, sir, Dr. Hisham. I'm Shivakamini Chandramohan. My metric number is EX03685. Today, I'm going to present about WorldCom, the company that has the biggest accounting scandal in American history. The story. Okay, firstly, let us look about company's background. In 1983, three investors including Bernard Ebbers formed Long Distance Discount Services Incorporated, which was based in Jackson, Mississippi. And in 1985, Bernard Ebbers was named as CEO of the company. In 1989, the company became a public company as a corporation as a result of a merger with Advantage Companies Incorporated. Then, in 1995, the company acquired over 60 telecommunications firms, and secondly, it changed its name to WorldCom. Then it changed its name again to LDDS WorldCom and relocated to Clinton, Mississippi. In 1999, Sprint and WorldCom announced a merger agreement, but unfortunately the merger was unsuccessful. In 2000, both companies terminated their merger process, and MCI WorldCom simply renamed as WorldCom. Additionally, WorldCom was the largest telecommunication provider in United States after AT&T, which is also a telecommunication provider in US, in 1998 and 2002. From 1998 to 2002, the company performed 70 mergers and acquisition purchased 30 companies. Now we will see how it all started, how this scandal started. Firstly, as WorldCom was enjoying name and fame, there was a huge pressure both externally and internally to be number one. The competition was high. The Sprint company demerger was a factor that the company has lost, and the expenses of the line costs were increasing. The merger and acquisition performed by the company was also decreasing, and the pressure to meet the expectation of Wall Street magazine was high. The increase in expense ratio, this is how it is happened. Firstly, the company anticipated high demand in the industry and increased their leased networks. Suddenly, there was a decline in growth of telecommunication industry and reducing the demand of networks. The hefty lines for unutilized networks was launched, and the WorldCom outsourced some portions of its calls, and they also paid the outside service providers for carrying WorldCom customers called on their lines, and then they took majority of its lines on lease because they anticipated high demand in the industry. Okay, here is how the company was pressurized. WorldCom and other telecommunications firms have faced reduced demand as the dot-com boomed and the economy entered recession. Revenues fall short of expectations while debt remains as high. With failure of Sprint merger, it faced a severe setback. which is not good, and the shareholder expectations were high, profits were getting low, decreasing, and the market value of company's common stock plunged from about $150 million in Jan 2000 to less than $150 million in July 2002. Okay, here is what WorldCom did. The frauds are: WorldCom accounting department underreported lines cost, which is understating amount. Secondly, the company inflated revenue by $1 billion. That was huge. Here are the wrongdoings of the company. They reduced the amount of money held in reserve by 2.8 billion and moved this money into the revenue line of its financial statements, which is technically wrong in accounting. In 2000, they classified operating expenses as long-term capital investments worth $3.85 billion, which is also technically wrong in accounting. The changes turned WorldCom's losses into profits to the tune of $1.38 billion in 2001. It also made World.com's assets appear more valuable. This happened because they took the money from reserve and put in revenue line, and then the expenses in capital investments, so the profits and the assets were more valuable. They also added a journal entry of $500 million in computer expenses, but supporting documents were not found. Bernard Ebbers also takes out a separate $43 million loan to finance the purchase of 500,000 acre ranch backed by Ebbers' World.com stock. Then Scott Sullivan, who is the CFO of the company, misallocated capital expenditure as normal expense, thus turning profits into losses worth $9 billion. This was not discovered by the internal auditor Cynthia Cooper until 2002. Here how they discovered this fraud. Firstly, by World.com's own internal audit department. They uncovered $3.8 billion of the fraud. Secondly, the Security and Exchange Commission (SEC) launched an investigation to investigate the fraud. Here are the revelations from the investigation. When irregularities were spotted in MCI's books, the SEC requested that WorldCom provide more information. The SEC was suspicious as World.com was making too much profit while AT&T, another telecommunication provider, was losing money. An internal audit found that WorldCom had announced as capital as well as the $500 million in undocumented computer expenses. There was also another $2 billion in questionable entries. WorldCom's audit committee was asked for documents. At last, they admitted to inflate its profits by $3.8 billion and not following GAAP, which is generally accepted accounting principles, over the previous 5 quarters. A little over a month, WorldCom filed for Chapter 11 bankruptcy. Chapter 11 bankruptcy is a chapter of the United States Bankruptcy Code which permits reorganization under the bankruptcy laws of United States. Now, what happened after that? The accountants of WorldCom was Arthur Andersen, who also looked after Enron's books as well. Andersen accused Mr. Sullivan, the CEO, the CFO of withholding information from them. WorldCom has new accountants KPMG who have been asked to score the books back to 1999. They said to be write-off of $50 billion when restates its finances. It is one of the largest written off in corporate history. Here are the CEO and CFO of World.com. He is the CEO of World.com and he is the CFO of World.com. CEO is Bernard Ebbers. He stated that I know what I don't know. To this day, I don't know technology and I don't know finance or accounting. And he is the CEO of the company. These are the consequences. The stock in mid-1999 was negative $64.50 a share. After announcement of bankruptcy, it went below $1 per share, and today it's negative $0.06 per share. 57,000 employees lost jobs, and $180 billion of shareholder value lost, and the company had to pay SEC $750 million as a settlement. These are the legal trials. First, the Bernard Ebbers was sentenced 25 years of imprisonment, and awaiting sentencing, Scott Sullivan was going to face 25 years of imprisonment. Here are that's all for the story and the consequences of WorldCom. Here is what I learned from this story, this scandal. Firstly, before becoming a CEO or CFO of a company, one should know about accounting, audit, and taxation in detail, so that there will be no fraud and the financial statement, the finance will be true and fair in the company. As Abbas said that he didn't know about finance or accounting, anything. And thirdly, always discuss with company employees when executing a plan that you don't know. I don't mean that you don't know. If you're not sure about the plan, always discuss with the employees. They should have better ideas than you. That's why. And I knew the importance of supporting documents of transactions. And lastly, always prepare a backup plan when executing another plan in case if it didn't work. It will be also applicable in our lives. Thank you. That's all from my presentation. Thank you, Doctor.